Okay, and then if you have a semi-established or a fully established practice, restaurant, business, are they going to have to come up with 25% in order to maybe, let's say, move their operation into a building or condo space, or are they going to be able to, do it with a little bit less skin in the game?
Yeah, so a small business that's been established and kind of fits the criteria. Well, the criteria again is you've got at least greater than 3 years of in business, you're profitable, kind of low leverage. Then no, they're not going to have to necessarily put as much down on a project if they're looking to expand. An expansion, I mean, if they're buying real estate, you can put as little as 10%. If you're looking for working capital or maybe to acquire a competitor, typically about 20% down is going to be the requirement. And again, if you've got personal collateral you can pledge on the real estate side or maybe more cash, they're going to look to be fully secured if it's available. But it's a great program. And, there are conventional loans too for someone that's pretty liquid and solvent and it's got very strong ratios. It could be even a conventional loan option for them.
Okay. In my space, you don't see a lot of conventional loans, although obviously if you can qualify for it, it's cheaper, right?
Right.
They don't ask for as much collateral, but you're going to see a lot of SBA loans when you're dealing with small businesses because they just don't have the necessary capital to put
Right.
down a 25% and kind of A plus, credit rating, right? So if there's a client or if there's somebody out there that's looking to get an SBA product, what kind of things can they expect to kind of pledge or to collateralize? Is it basically a like blanket, like anything with equity that they own is going to be collateral for an SBA loan?
Ooh, so I would say to get prepared, I mean, the first thing in the due diligence process is you want to have your financials in order, and your banker is going to look at your personal financial statement. So on that statement, they're going to look at the available assets you have. They're not necessarily going to look at your vehicles personally or maybe your retirement account because that's not even eligible. They're going to look at really your real estate holdings. First is going to be your primary residence. Do you have any lendable equity in that? If you do, and there's a collateral shortfall, then they're going to want to put a lien against that for the shortfall amount. They'll look at the business and does it have assets that can be used to pledge. I mean, they're going to look at a blanket UCC filing if it's available. So they're going to look at unencumbered equipment, accounts receivable, inventory, and cash. But, I always start off with the personal financial statement so I can see what kind of assets the borrower has so we know up front, hey, this might be needed to pledge to get this loan qualified. So I would say, the advice I give to small business owners is get your ducks in a row, have your tax returns organized, have your CPA prepare your financial statements, and put together a personal financial statement so we can look at your cash flow, look at your liquidity, look at your available assets, and determine, is this the right route to go?
Got it. Okay. All right. So let's move a little bit away from that and let's talk about what are the typical terms of a loan that you're looking at, like if you're going out to acquire a commercial property?
Yeah, so on a purchase for a small business owner, if they're going to take advantage of an SBA loan, you've got, again, those two options, a 7A or a 504.
Yeah.
So a 7A loan normally is going to be a one loan with the bank. So you're going to be dealing with just your bank or maybe a community bank or a credit union that's offering SBA loans, even some non-bank SBA lenders that are out there. So a 7A is going to be a 25-year loan, fully amortized. You do have fixed rate options. A lot of lenders do variable rates, and the variable rates are normally tied to prime and adjust on a quarterly basis. So prime-based loans, I would say. But some A-paper borrowers that have got clean credit history and real strong financials, you can get a 25-year fixed rate loan.